Well, hi. Welcome to Insurance Insider. I am Jeremy Hallett. Thanks for tuning in. These have been really fun. I'm enjoying them. I hope you're enjoying them as well. Today, we're going to actually be talking about cross-purchase buy-sell agreements. Last week, we did entity purchase. So before we get into cross-purchase buy-sell today, just a quick refresher, a buy-sell agreement is a legally binding contract that establishes under what conditions, to whom, and at what price an owner, partner, or shareholder can or actually must sell their business interest upon a triggering event. That agreement gives business owners assurance about who will purchase the deceased owner's interest, what price will be paid, and when that sale will take place, and how the purchase will be funded, typically with life insurance. So here's how it works. We got this buy-sell agreement, and it specifies a fixed purchase price, or it provides a formula for establishing that price. A little bit later, we'll talk about some of the things that might go into the formula or into the fixed purchase price. Under a cross-purchase buy-sell agreement, each business owner individually agrees to buy a part of the deceased owner's interest. And this is in contrast to the entity purchase buy-sell agreement, in which the business itself agrees to buy the interest. So cross-purchase, business owners, partners buy the interest from each other. Entity purchases, the business is the one that actually buys that. So to fund a cross-purchase buyout, each owner ends up purchasing a life insurance policy on the life of every other owner. So added together, the proceeds from these policies on the deceased owner will equal the purchase price for that owner's share of the business. Each owner ends up buying, owns, and is actually the beneficiary of the individual policies covering the life of each owner or each other owner. So for example, actually many times these are two, cross-purchase ends up being two partners. Each one owns a policy on the other. That's very common. But an example of three makes a little more sense to see cross-purchase. So three partners, they each own equal shares of a business that's valued $3 million. And each owner's share is worth $1 million. So to fund a cross-purchase agreement, owners 1 and 2 purchase a $500,000 policy covering owner 3. Owners 2 and 3 each purchase a $500,000 policy on owner 1. And owners 1 and 3 each purchase a $500,000 policy on owner 2. So the result is 2 policies covering each owner for a total of 6 policies, and then each owner has $1 million of life insurance on them. So if one owner dies, each of the surviving owners uses the life insurance proceeds to purchase the share of that deceased owner's interest. So here's what happens. That cross-purchase agreements generally provide an equitable way to divide a surviving owner's business interest so that the post-death ownership interests remain relatively the same in relation to the other owners. And if those relationships are unequal to begin with, they'll remain unequal. So for example, let's say Alma owns 60% of a business, Betty owns 20, and Catherine owns 20. Again, we're 3 parties in this one. Most of the time it's 2, but 60, 20, 20. So under a cross-purchase agreement, it states that if one owner dies, his or her interest is divided equally between the other survivors. Therefore, if Betty dies, Betty was one of the ones that owned 20%, then Alma's ownership would grow from 60 to 70, and Catherine's interest would have grown from 20 to 30%. Make sense? So life insurance policies paid by each individual owner are not tax deductible. I keep saying that most of these. Life insurance premiums aren't tax deductible. That being said, the proceeds are not taxed, which is the magic of life insurance. If a corporation is actually paying the premiums on behalf of the shareholder and employees, such as with the Bonus 162 plan, that corporation can deduct the premiums as a reasonable and necessary business expense, as long as those premiums paid are reported as salary. If they're treated as dividends, obviously then the business cannot deduct those premiums that are paid. But either way, the shareholder employee must report these amounts as income. Okay, those surviving owners receive an increase in basis under a cross-purchase agreement that isn't available in the entity purchase or the stock redemption agreement. And that basis increase is real attractive, which means many buy-sell agreements end up being cross-purchase. That basis increase, actually, it reduces the amount of capital gains tax due when or if a sale of that business interest occurs. So that being said, my brother and I, we have a buy-sell agreement. We each own policies on one another. So if I were to die, Ryan's going to get called that $1 million, and Ryan ends up turning around and buying my shares of the business back from me, which then increases his basis in the business by $1 million, and then he owns all of my shares. So that's probably the main reason we do a cross-purchase whenever possible, is that basis increase. Now, any cash value in these policies, if they're permanent, they're not actually going to be usable by the company, because they're not owned by the company. They're owned by the individual business or individual partner or owner of the business. Now, that purchase price to get this buy settlement together can either fix the value for federal estate tax purposes. It pretty much always does, as long as the legal requirements are met. And then that agreement ends up being based on the price of the business gets based on either, like I said, a fixed price or a professional appraisal / formula. And then that considers a whole bunch of factors, such as a company's earning history, the future earnings potential, the book value of the company's assets, the general financial condition of the business, any prior sales of business interests, obviously the goodwill of a company, it's very large, the outlook for the industry, and frankly, you can even use the economy in general. Put all these factors together and we come up with either a formula or a fixed business. And then we take a look at that cross purchase agreement so that we can get a step up in basis. And each business owner ends up owning a life insurance policy on the other to fund the buyout in the event of a death. There are a few potential downsides. In a business with many owners, that cross purchase agreement is cumbersome because of the number of policies ending up being involved. So, for example, with 6 owners, each owner must buy a policy on the other 5. So that's 6 times 5. That's 30 life insurance policies that would be needed to fund the agreement. It doesn't work. We wouldn't do it with 6. If there's a wide disparity in the owners' ages, the younger owners carry a greater premium burden since the policies on the older owners would cost more. So again, 70-year-old, 30-year-old, that 30-year-old would be paying premiums for the 70-year-old, and the 70-year-old would be buying on the 30. And those tend to work better with entity purchase just because of the disparity of ages. And then that business actually cannot, as I said, use the cash values that will accumulate in the policies since the business doesn't own the policy. So if we wanted to use that life insurance to go to the bank to get loans or to use for other circumstances, we would also not want to use a cross purchase. Now, there is actually a multi-purpose solution for many partners, that's 6 owners together. That's called a trusteed cross purchase agreement. I think we spelled it out there. It's not trusted, it's trusteed. So the trusteed arrangement works only if the owners are partners in a partnership. This doesn't work in an LLC. Otherwise, the transfer of value rule will taint the death benefits after the first death. It works once. So with a trusteed agreement, the trustee purchases and owns life insurance on each owner, reducing the number of policies to the number of owners, just like we would with an entity purchase. But a trustee cross purchase collects those premium policies from when an owner dies, and then it pays those proceeds to the deceased owner's estate and transfers the deceased owner's shares to the surviving owners in agreed upon proportions. And we fully fund these typically with life insurance. Ends up being an invaluable tool in helping business owners establish a price for their share of the business. It secures the buyer. It ensures that the money's there to purchase the interest when the need arises. And like I said, choosing that type of agreement, either cross-purchase or entity, depends on the characteristics of the business and actually on the owner's wishes. So yeah, that's a cross-purchase, probably the most common of all the buy-sell agreements that end up being funded with life insurance out there. Thanks for listening. Go ahead, hit the like button if you want. That would be awesome. If you leave a comment or a question or keep this conversation going, that would be wonderful. Share this with any business owners. We're all out there doing the best to take care of the public, and these solutions that are going out onto LinkedIn are part of that process. Thanks again for listening. I'm Jeremy Hallett, and this is Insurance Insider.